All right, gents. Today, I think the topic should be the post-pandemic economy and how that might shape up, and what are the key elements to that. Does anyone want to kick me off?
I'll kick you off. First of all, he called us gents. We're not gentlemen. Well, he might be. I'm not.
I'd like to hope you
I'm a
are. You're
thug.
sat right next to me.
Yeah,
Yes,
I
but
fake it well.
I'm a psycho thug.
Really?
I can sit next to you. It's fine. I'll get you on the net later. Okay. Now, here's my thought. I think the three things we want to consider briefly on the post-pandemic shape. One is the consumer, the household, has actually been paid a vast amount of money by the government, which she or he has not been able to spend online. So massive savings, 12, 15. I think it was the Bank of England governor said 20% of the UK economy is now sitting in savings. So now that you don't need the savings, as they're vaccinated and not dying, unlike ourselves or people in this region, and they'll go out and spend it. So you're going to get kind of almost like the baby boom after the Second World War boom. That's number one. Okay. Number two is big government really like this because it's going to keep them in power. So they're not going to stop spending the money. What does that mean? And I think we have things to say about bonds versus equities, because governments don't issue bonds to fund the spending they don't have money for. They issue bonds. So bonds versus equities, very important, what Richard said. And the third thing is there's something absolutely weird going on.
And what's that?
When the pandemic hit, we all thought that corporations would collapse.
Yeah.
No, they didn't collapse. The bankruptcies are at almost a low for 10 years. Corporations have built up immense amounts of money. Profits only fell by 7% versus a consensus forecast of 37%. And now they're spending money like there's no tomorrow on capacity, which they are supposed, according to the post-pandemic theory, not to need. Are they replacing people? Is it the Holy Ghost? Let us see.
There we go.
Okay.
Clearly coming from the Catholic side of things, all of that seems to lead straight to inflation, doesn't it? I mean, you've got a lot of money chasing too few goods all at the same time. I mean, I think some of those savings figures are probably inflated, but there's no doubt, I think we're all thinking, can't wait to get on an aeroplane, can't wait to spend a bit of money. Some of that money's already spent, of course, it's just been deferred. But it's leading to really a period of inflation and a period of expectations of prices going up. Now, we're not necessarily seeing it at the moment, except in the asset markets, but it has to come, according to that theory.
Yes, but then, no, Carolyn, you come in now. I've been bullying you. You called me a thug earlier.
You called yourself a thug.
Oh, no,
I think that was it. Are you certain
well, at least
that people...
somebody's agreed.
Are you certain that people really are going to start spending that pile of cash they've been sitting on, or are they going to be paranoid? When are they going to start spending this money? When are we basically going to hit the roaring 20s where everyone goes out and has a massive party?
Well, I think it's a mixture of both, because, of course, a lot of people are unemployed, especially if you look at third world countries, or are we allowed to still say that, developing countries. They're in a situation. I was speaking to a hotelier yesterday, and he's already lost 60 or 70% of the jobs in an area of the jobs that he has under his control, in an area that really needs jobs. So I think there will be a sense that, yes, maybe we need to hold a little bit back, for the rainy day. But once again, if we do see inflation come in, then people are going to think, well, I might as well spend now instead of holding on to it and watching it disappear.
That's a good point. Richard made a good point.
Is that the first time?
Doesn't happen very often.
No, I think people spending ahead of time because they think inflation will happen in the next time is a very key point if that happens. About the developing economies, we've got to remember that there are an awful lot of people in our own economies who are, in a sense, low skill, low jobs, not probably through any of their own fault, but opportunity, who also lost jobs because they worked in the face-to-face industry, the service industry, and they have lost their jobs. And I don't know whether humanity has learned anything and become better during the pandemic. I'm being told by one of my daughters that, we have learned to read instead of playing on the internet. We have learned the real depth of relationships because we can actually Zoom each other and examine ourselves. And the other one says, I want a party. So I don't know which way the universe is going to go, but I suspect we will see a pretty fast return to greed and normalcy. And that, say, say a normal savings rate is 5%. At the moment, call it 15, maybe 20%. Half of that gets spent, the rest gets kind of kept as a precautionary savings for a rainy day, but you still get a boom. Now, the second point, I think is very key to move on to it, is why on earth are corporations investing when actually even small corporations in vast numbers were propped up by the government. Of course, they have no intention of paying that money back, but they're investing in capacity. They're putting it into fixed assets. They're putting it into software. What is that? Is that because finally the technological revolution is having a productivity impact on capital? Is it because the Holy Ghost is really a major factor in how economics works, but economics does not recognize the divine presence? Or is this actually because they're replacing people with machines? Because people are sickly, unreliable.
They are very unreliable.
It's actually quite cool to have machines, you know, nice, shiny things knocking around. And I think you're right. And we are going to have, I think, a crisis, certainly among unskilled people who are replaced by technology. I mean, a lot of that's happened in the banks already, of course, where actually even skilled people have been replaced by technology. So I think that's happening. But that's also intensified by the fact that interest rates are so low that we have a series of zombie companies out there who are only afloat because they're not paying any interest bill. But I think we actually also have now a posse of zombie employees out there who've been supported by the government bailing them out to try and keep these companies going. So somewhere down the line, you know, you're talking about economics and the Holy Ghost. Well, the Holy Ghost does work strangely in economics because it does balance itself out. You know, eventually all this money created by government is going to have to be paid for. It's a great leveler. And sooner or later, I think we're going to come to a situation where those zombie companies and zombie people are going to have to pay the price for just hanging around too long.
Yes, and of course, Janet Yellen sees this because she's arguing for universal harmonized, meaning high tax rates. And of course, Germany and France have signed on because they're afraid of nasty difficulties setting up a Singapore on the Thames
already.
Yes, but the high. And of course, you know, yes, the piper has to be paid. How will the piper be paid? It'll be paid because corporate taxes will go up for those that can pay them, and because the rich will get to share finally in social welfare.
Well, the two things about Yellen is that she's talking about corporate taxation going up from the ridiculously low Trump levels of 21%. to ridiculously low in European terms of 28%. So I think that's quite good. But the real interesting move, I think, is that if the US does come in with an element of leadership in looking at higher corporate taxation, you may well get harmonization between Europe and the US. That's going to be a pretty big chunk of the world where corporate taxes are definitely going to go up.
And markets will go down. And Caroline, so beyond listening to boring people, I mean, you're a real person in out there, and in fact, you're the only real economic person we have. What do you think?
Very true.
Well, my worry is definitely about the inequalities that this whole situation is going to expose. You were talking there about the number of people who have been through like government furlough schemes, who are currently being kept afloat, and they might have their nice bit of savings. But what is going to happen, you know, when they are replaced by a robot? Are we going to have a mass of people, whether they are skilled or unskilled, and whether there are massive imbalances? Because I think one of the other things the pandemic has really exposed is how unequal the world is, you know, and so it's the kind of people who have families with children who have really had to stay at home because the schools haven't been open and there's no one else there to look after the kids. So the women have been the ones who have, you know, most had to give up what they were doing. So are we sort of basically setting ourselves back a number of years here, or how's it going to work?
I think Richard will tell us more about it in terms of financial markets, but you're going to a slow productivity, big government, low growth, in which the people you're talking about, the people who should be polarized, should be popularized, are in a sense the victims for many, many years of COVID, and they have to be bought off, and they will be bought off by governments, which will make Richard pay higher taxes. That's what I think what's going to happen. But the overall outlook is higher inflation, lower productivity, and a redistribution of profits. What does that mean for investors, though? That's the key question. Now, I don't know, because, and nobody should listen to me on this, because I'm really not an investor. I'm too impoverished to be successful. So let's talk to successful ones like Richard about it.
Well, I'd like to think so, although you know, history may prove me wrong. No, I actually think that investments, corporate investments, will continue to do well, because governments are going to have to continue to create money. They're going to have to support people in low paid areas. It's basically going to be a transfer of money directly from the government printing press to entrepreneurs, to owners of capital. That's been happening now probably for 15 or so years. I can't really see that changing. You know, we're in a situation where at the moment, a husband and wife can go out to work when they could go out to work, and still not really have enough money for a holiday. So government's been supporting that in things like income support. So I can't really see any slowdown. And essentially it's a transfer of money from government into the equity market. So that's why I think they're likely to be supported for a while. Some equities will do well out of inflation, some won't. So maybe it'll be a return to the active investor, the active manager who picks his investments. But I think that situation is going to be quite positive for equities. On the other hand, if we have interest rates going up, as inevitably they have to, that's going to be negative for equities. But I think the trick is going to be that it's not all going to happen at the same time. We're probably going to get a boom in the equity markets and then a bust in the equity markets when interest rate goes up. So you're going to have to be pretty light on your feet. And just as the man said, the infamous Chuck Prince comment of Citibank during the global financial crisis, you're going to have to keep on dancing.
Okay, so where do bonds versus equities come into this?
Well, generally, there's been a relationship between bonds and equities. So if bonds go up, equities go up, and bond yields or interest rates are the reverse of bonds. So generally, if interest rates go up, equities gone down. But that relationship has broken down pretty well since the global financial crisis in the world of zero interest rates. And I think it'll continue to break down for a while. So I think we'll continue to see equity markets outstrip the bond markets for a while. Until all the bad stuff hits the fan somewhere down the road. When that's going to happen, we don't know. I think, David, you're thinking a lot nearer than I am, because I have a lot of faith in the market to continue to remain more irrational than I can.
Well, I will never try and time irrationality, particularly against you, because you're obviously the voice of reason. So, what on earth could I correct?
Well, I have this sincere voice, you see, that if you can fake a sincere voice, you've got it made.